Yesterday we were discussing about arbitrage opportunities. So suppose this is market one, market two. In market one something is available for 10 rupees and it is trading for 30 rupees in market two. So people will start buying from buying from market one and start selling in market two. So what will happen? This will not last. This arbitrage opportunity will be exploited by many people. They will start buying from here and they'll start selling here. So what will happen when people start buying in market one? The prices start rising. It goes to 12 rupees. And as supply is increasing in market two, the prices start falling. It becomes 28 rupees. Now this goes to, you know, 13. This goes to 25. Like that, one day, here the prices will be 18 in market one, and here also the prices will be 18 in market two. And now there is no arbitrage opportunity because people will buy from market one at 18 and market two also at 18. There is no opportunity here which has to be exploited. So this is the arbitrage opportunity. Okay. Now let's understand the purchase power parity theorem. So purchase power parity theorem is nothing but in both the markets now the prices are same. This is parity. They have to be same at any cost. How they will be same? The market forces will make them same. How the market forces will make them same? I have just explained you. As in the market one, the prices were less, people start buying excessively. So it drives the prices up and it has made the price to 18 now. And as they start selling in market two, the prices in market two have, the supply in market two has increased a lot because a lot of people have, purchased from market one and start selling in market two with more supply and less demand. Slowly the prices in market 2 will fall and one day it will become 18 and they have to become equal. When they become equal, there's no arbitrage opportunity left over. Now we are going to find out that fair no arbitrage forward price with the help of this equation. So what is this equation saying? Purchase power parity. This equation is a function of inflation in two different countries. I will tell you country A, country B. This country has high inflation, let's say 7%. This country has low inflation, let's say 2%. This country's currency will be weaker. That means as the time will pass, this country's currency will become weaker and this will depreciate, and this country's currency will be stronger and it will appreciate. This is because of the inflation. Here everything is very costly. The purchasing power of this currency has gone down. Since the purchasing power of this currency has gone literally very down, this currency will be able to buy less units of this currency. Hence, the purchasing power of this currency is less and the demand for this currency will also be less. Why? Because the things will be very costly in this country. Since things will be very costly in this country, no one will be showing demand to buy this country's goods. Hence, since no one will be showing demand to buy the country's goods, this country's currency will not be having any demand in the market. No demand, the currency falls. That I can prove you with the help of purchase power parity theory. No need to mug up any of the formulas. We can directly do. Let's see a question. Spot exchange rate between country A and country B. So $1 is available for 8 kroners. This is the spot exchange rate. Assuming that there is now purchasing parity, an amount of commodity costing $110 in country A will cost 880 kroners in country B. So there is parity. $110 in country A will cost 880 kroners in country B. So if we exchange this, we see the exchange as, so here uh, one commodity. So if you want to exchange this currency, you can see that 880 kroners. So $110. $1, how many kroners? 11 ones are 11 eights are. So 8 kroners for $1 is the exchange rate. You can check it here. Now what has happened over the next year? Price inflation in country B, whose currency is kroner. Over the next year, price inflation in country B is expected to be 5%, while inflation in country A is expected to be 8%. So, what is the conditions given here? Inflation in country A, in country B, the inflation is going to be 5%. And in country A, inflation is expected to be 8%. So, country A's currency is going to weaken. Country A's currency is going to weaken. So I'll tell you country A and country B. Country A's currency is what? Dollar. Country B's currency is what? Kroner. Country A's inflation is what? 8%. Country B's inflation is what? 5%. Which country's inflation is high? Country A. That means its currency is going to fall, depreciate. And which country's currency is country's currency like here is going to appreciate? Kroner. Why? Because the inflation is less. So kroner is going to appreciate. We're going to prove that. See how. We will take country A's currency dollar, $1 into what is the inflation rate in country A? 1.1 plus 0.08 is equal to what's the country B's currency? Kroner. What is the exchange rate? 8 kroners. What is the interest rate in country B? Sorry, what is the inflation rate in country B? 5%. 1 plus 0.05. We are going to take this here. $1 is equal to 8 kroners. 1.05. 1.08. Please calculate. You'll get the exchange rate. So $1 is equal to 7.77 kroners. Here we can see kroner has appreciated, dollar has depreciated because high inflation in the, the country which has dollar as the currency. Please have a look to this. We'll move forward fast. Next, please do this as a homework. See, any homework which I am giving, if you're not getting, you can let me know. I can solve all the questions in any of the classes. Okay. Now, interest rates. We are going for interest rate parity theory. What is this interest rates? In long term, two countries, A and B, of similar risk should offer similar rates of return to international investors. So any differences in interest rates should reflect differences in inflation. So what they are saying is, as we have discussed right now, purchase power parity. We have just discussed that in a country A and country B, the inflation rates are different, right? They're saying that there should be a parity in long run. We discussed that the prices in country A and the prices in country B will become equal in long run. But till the time they're not equal, there's no parity. Arbitrage opportunities are there. One day there will be a parity. So here also you saw, but here what we are trying to say is the country whose inflation rate is high, its currency will definitely fall. Here the current inflation was high, its currency has fallen. No arbitrage exchange rate. Here also, I can prove you with an example the statement. In long term, two countries of similar risk, that means the risk should be similar, should offer similar rates of return to international investors. So any difference in interest rates would reflect difference in inflation. The reason for difference in interest rates is because of difference in inflation in both the countries. That means inflation has a direct impact on interest rates. You know that a country, let's say country A has high inflation, very high inflation. The monetary policy of this country would be what? To increase the interest rates. Now in India, the inflation is going to rise because things have become very costly in India now. Everything, the petrol, diesel prices have increased. That will, that will have a cascading effect. Everything which is connected with petrol, diesel will be, the prices will be going high. Okay, we can't do anything. We have to bear all this. So what will the country's banks do? Since the inflation is very high and the financial system will become very weaker because more money has to go out from the banks to buy things. What they will do, since people's demand for currency or money will be very high. Okay, so to control that, they will increase the interest. They will increase the interest rates, monetary policy. As they increase the interest rates, that's a clear indication the inflation in the country A is very high. The country A's inflation being high, its currency value will fall, or its currency demand will decrease. Why? Because its purchasing power will be less. Why? Because things are made very costly in this country. That's the reason why people will not buy this country's currency. So in the long run, its currency value is going to fall, and we're going to see that. I'm going to prove that. So we can draw a conclusion. The country A and country B. Country A's inflation is very high. Its interest rates will be high. This two inflation high, the monetary policy will be, interest rates will be high. The government doesn't want people to take more loans now. Don't show more demand for loans, because there's high inflation. If you make things also, it will be very costly, and there'll be less demand for your products. And financial system is also becoming hollow. So what they'll do, since they want to curb this, they don't want people to take more currency out of the banks. Okay, they want to restrict it. So with slowly, steadily, what will happen? That means they are, restricting the money supply. They are restricting the money supply. So, if interest rates are high, two things are going to happen. Loans are going to go down because less demand for loans, and deposits are going to happen more. With this, less money going out in the from the bank, more money coming into the bank. Okay, the supply is decreasing, and again more money is coming into banks. So what they are doing, they are restricting money supply. Okay, because there's high, because they want to create demand for the money. Okay, so how come they create the demand for money? With more deposits. With more deposits, less loans, less supply of money. Slowly, steadily, what will happen? Slowly, steadily, uh, the as you know, more and more money goes out of the bank. Okay, and goods made, the goods are very costly in the market. If the goods are very costly in the market, people will not buy more goods now. Why will they not buy more goods? Because goods are very costly. So people show less demand for goods. As it is going to happen now, the things are going to become very costly. So we will restrict our purchases. We will start depositing more money in the banks. We will start, restricting our purchases in the market. With that, slowly, steadily, the supply of goods will increase in the market. Okay, and that will decrease the demand. That will decrease the prices for those goods, because if the supply increases, the prices decreases, and the inflation comes down. This is the reason why the interest rates are high. Again, I'll repeat, when there is so much of inflation in a country, the monetary policy of that country's banks would be to increase the interest rates. Why they increase the interest rates? Because things are very costly right now. If bought now, more money will go out from the banks, and banks will become hollow. So the financial system will become weak. So what they do is they increase the interest rates. With increasing the interest rates, they are restricting money supply. So, and they are encouraging people to deposit more by giving high interest rates. High interest rates is nothing but deposit rate will be high and loans rate will be high. Loans will be high, deposit will be high. If deposit will be high, people deposit more. If loans will be high, people will take less loans. Less loans, less demand, more supply. Yes or no? Less loans right now, less loans are given, right? People are not taking more loans because high interest rates are deterring them to take more loans. So less loans, more demand. Of course, the interest rates are very high right now, and with slowly with passage of time, what's going to happen? The financial system is going to become very strong. More money supply into the financial system. Yes, and less demand from the financial system. So today they are paying high interest rates. With lot of money coming to them, they'll try to decrease the interest rates. And vice versa, if we see here, companies which were producing goods by taking loans, okay, they will continue the production, but people will not buy during the inflationary times. Why people will not buy during the inflationary times? Because things are very costly. So they show less demand. They don't go to shops. With this, the production will continue. The supply will continue. One day, what will happen? Supply will increase, demand will decrease. When supply is high, demand is less, the prices go down, and in this way, the inflation goes down. Okay. Once the inflation goes down, things become normalized. Fine. Now, so what we have understood is the root cause for increase in the interest rates is inflation. And two countries, okay, have two different interest rates. The country whose interest rate is high is more inflated. The country whose interest rate is less inflated. Okay, that's the point. Now, you see with an example, as we understood that interest rates are impacted because of inflation, we are going to find out the forward, no arbitrage forward exchange rate. Okay, no arbitrage forward exchange rate, we can find out. This is a function of interest rates. Two countries, A and B, have interest rates as 7% and 2%. So $1 is equal to 70 rupees, let's say. Definitely, I can tell one thing. Country A is India and country B is US. Country A's interest rates are very high. That means inflation is very high in country A. Country B's interest rates are 2%, that is US dollar, and its inflation is very less. The country whose inflation is high, its interest rates will also be high, and this country's currency is going to fall in value. Okay, because the purchasing power will be less. Everything is interconnected. See, high inflation, high interest rates, less purchasing power of currency, because inflation is high, things are very costly in this country, so no one will buy this country's currency, no, less trade, so purchasing power is weak, the currency value will fall. We can prove that with the help of one this formula. Spot rate today into one, so we are not going to mug up any of the formulas. I'm going to take Indian currency and US currency. So $1 into, what is the currency interest rate in US? 1.02. 1 plus 0.02 is equal to 70 rupees into 1.07. Now you see, $1. How is rupee going to fall? So $1 has become 73.43 going forward. That means this is the forward exchange rate. What does it show? Rupee has depreciated. More rupees required to buy $1. Why? Because in India, inflation is high, interest rates are high, purchasing power of rupee is low. So rupee weakens, becomes a weak currency. Okay, that's why. So this is the point. With this, we understood everything. Here also there's a question, activity 8. You can check it out. Company based in country A, where currency is dollar and is expected to receive Kuwaiti dinars in 6 months' time. Spot rate one 5.6470 dinars for $1. Country A's interest rate 8%. Kuwait 6%. So $1 $1 into 1 plus 0.08 is equal to 5.64670 Kuwaiti dinars into 1.1 plus 0.06. As the interest rates in Kuwait are less, the inflation in Kuwait is less. Okay. And Kuwait's currency's purchasing power is high and it's going to appreciate, and dollar is going to depreciate. So 5.4670. Just calculate. And I can really see that has become 5.365. That means now 5.6365 Kuwaiti dinars are enough to buy $1. That shows this has appreciated. Okay. Now we are going to discuss about four-way equivalence. It's the last and final topic. See, what is four-way equivalence? Inflation rate differences. Two countries, A and B, having two different inflation rates, definitely have an impact on interest rates. We discussed, right? If a country A has more inflation, its interest rates will be high. Inflation also has an impact on exchange rates. The country whose inflation is high, its currency will fall when compared to this. That is also understood. Interest rate differences. Yes, we have taken the IRP, interest rate parity theorem, and we found out the forward rates. Yes, we can do this. And interest rates, definitely forward exchange rates with IRP. And forward rates definitely tell you, show the difference, how the things have changed from spot rate to forward rate. The only reason the spot rate has changed going forward is due to inflation, interest rates, etc. So all are interconnected. Okay, you can see here clearly. Forward rates are calculated by interest rate differences. High interest rates due to high inflation. Yes, if the inflation is high, interest rates will be high. High long-term interest rate predicts a decline in exchange rate. Yes, if the interest rates are high in a country, its exchange rate will go down because purchasing power is less. That also done. High inflation, fall in exchange rate. That also done. Everything is interconnected. See, translation risk, economic risk. What is translation risk? Risk that domestic currency value of foreign currency assets falls or the value of foreign currency liabilities rises. This is translation risk. That means if suppose you have a company here A and you have a company B in US, you have assets in this company in dollars and liabilities in this company as dollars. The risk is if you convert them into Indian currency and you do the consolidation, that means you make group accounts. Due to exchange rate risk, the assets value can fall and liability value can increase. That is the fear. That is translation risk. How we can reduce this? So see, let's say I have a receivable from US of $1,000 and I have a payables in US of $1,000. What I can do? I can ask my payables to pay to my, I can, ask my receivables, sorry, ask my receivables to pay to my payables. With this, what is going to happen is I'm not going to exchange rupee with dollars and I'm not going to make any payments. My customer in US is going to pay to my supplier. With this, what is happening? I'm saving myself from any exchanges. So to manage translation risk, a company that has assets in foreign currency can match these assets with liabilities in the same foreign currency. So I'm matching. Okay. Economic risk, see, it is there. A country, two countries, US and India, the economy of these two countries are not the same of in size or business, etc. So due to long-term movements in exchange rate, that damage the value of a company because the net present value of companies value of the business cash flows is diminished by expected exchange rate trends. See, if a company in India and like has operations worldwide, so what is going to happen? Companies should carefully analyze potential exchange rate fluctuations so that they minimize the risk of. So it is constantly exporting to US, but what is happening? Its currency is, you know, if currency is falling, that's okay. But if currency is increasing, then the exports may get impacted. So even companies that do not export or import can be exposed to economic risk if a sustained movement in exchange rate benefits an overseas rival. Economic risk is difficult to manage effectively, but a recognized strategies to diversify its international operations. So let's say India and Bangladesh. These are two countries. If India's currency is going up and this current country's currency, let's say I'm not going to name any country, India and country X, its country's currency is weaker. So India's currency is stronger, weaker. So whose demand will be high in the international market for goods? This country's goods demand will be high. So Indian exporters are going to face this risk. Now their goods are less in demand in other markets. So what they have to do? They have to diversify. They have to look for different markets. This is economic risk. Okay. That's what. So we are done with this foreign currency risk. We will start with interest rate risk in the next session. Maybe tomorrow, if I have time, I'll start from here. Okay. Let's see what is the condition. This is done. Tomorrow, this I'm going to finish, and I have already given cost of capital, capital structure, and business valuations. Please finish them, please. Then we have only working capital section left over. FM will be finished, done. Okay. So I have to put full stop to this within this month. And FR is going in the weekends. So if by 31st FM is finished, next month FR will be done. Okay. So please match with the speed. I'm just, I've sent everything. Go through them. Okay. Thank you. Shall we? Okay. No, done with the class, right? See, shall I prove the interest rate parity theorem to you? See, this is India. This is US. The interest rates in India is 7%. In US, it is 2%. So what $1 is trading at, you know, let's say 70 rupees today. So US investors, if they invest in US $1,000, what they will get 1,020 at the end of the year at the rate of 2%, right? What they do is they want to take advantage of extra 5% interest rates in India. That means from US, if they compare, India is giving them extra 5% interest. But this difference in interest, which is 7% and 2%, the difference in interest is 5%. They will not be able to take advantage of this. Why? Because as the interest rates are in India is high, inflation in India is high. If inflation is high, interest rates will be high, the currency will fall, the purchasing power will fall. And Indian, if they are investing in India, so Indian rupee is their asset. If their asset value falls, what will happen? They will be incurring losses. So whatever extra 5% they wanted to, gain, they are going to lose that completely due to fall in Indian currency's exchange value. So I'm going to prove that. See, now let's say $1,000 they are investing in India. $1,000 into 70,000 they invest in India. 70,000 after 1 year will become how much? With 7%, 74,900. What is the exchange rate going to be? $1 into 1.02 is equal to 70 rupees into 1.07. 74.9 divided by 1.02. Sorry. India's interest rate is $1 into 1.02 is equal to 70 rupees. 0.07.